All right, I'll kick it off. Just one thing that I failed to mention at the beginning is that this room is a replica of the Chicago Stock Exchange. The two blackboards behind you are originals, but this is designed to be a complete replica of the Chicago Stock Exchange. And I also failed to acknowledge our friends at Lincoln Financial Group for their kind support of this event, so thanks so much. So as we close out the conference on the future of due diligence, I want to introduce Dave Sowerby, a longtime friend, a longtime Loomis Sales portfolio manager. Just under a year ago, he joined Ancora, the Cleveland-based micro, small, and mid-cap manager. Dave is a frequent commentator on CNBC, and he sat on many state and public pension boards. And so he's going to give a little insight, and then he's going to introduce our keynote, Ted Seides, and do a little Q&A. So with that, Dave, I'll turn it over to you.
This is the pledge. 10 minutes or less. We've all probably been to that concert where there's the warm-up act. I kind of feel like I'm the warm-up act for the Stones. If you're the warm-up act, you've got to know this. 2, maybe 3 songs, play the one song you know, and then exit. And that's really the mission today. As Guy said, I think I'm truly blessed because I get to work directly with clients. I get to manage money and be accountable for returns, whether it's private client or institutional. And what I really embrace is, over the years, I've had the chance and continue to sit on some good investment committees. I chaired my state plan for about 10 years. I sit on a $4 billion hospital committee, and out of bankruptcy chair City of Detroit pension fund. So what I thought in, again, the pledge, 10 minutes or less, is just talk briefly about portfolio construction, with the most important theme being anybody in this profession who really thinks they've got it all figured out. You don't walk from that trade, you run from that trade. That's key, and try to take a more thoughtful 2 to 3 year view in portfolio construction. I say that today, having taken a phone call during this event from a client who I'm going to see next week, and he wants to know, Dave, how's the year going? How's the quarter going? And I think when I get those questions, I've failed in my effort with trying to convince people to take a more thoughtful view. A few axioms guide me, either as an investment committee member or a portfolio manager, that number one, you make your most money when you run against the herd. Sometimes it's lonely, but intellectually stimulating, not to be consensus with everybody. Last, investing in the CNBC terms, as much as we watch it, it's not a binary event, right? It's not all or in. It's usually some degrees of risk and return. We know in June of 2018, investing is more about this stage of the cycle, not de-risking too much, but I know a few people in portfolios today that are saying, coming in front of committees or their clients and saying, I'm thinking about how to leverage up the portfolio and add a whole bunch of risk to the portfolio today. It's more about how you think about thoughtfully taking profits, maybe being a little bit early and wrong. But having done this for a few years, the conventional trade of sell stocks or reduce stocks as the risky assets and buy bonds, it's simple to say that trade ended in July of 2016. You could contend it ended even before that. So it's how you think about portfolio management going forward. And I promise to you, this isn't a market forecast. You can read all the sell side strategists and get the same conclusion and probably not make money. It's more about trying to think thoughtfully about portfolio construction. So I put a couple of balance sheet items up there. I think most importantly, what's appealing to me is, if you read the book by Thorndike on The Outsiders, it's one of my top 3 books. When somebody recommended it to me, I was like, Outliers. No, Outsiders. Outsiders, I read that in 7th grade. No, it's The Outsiders, by Thorndike about great capital allocators. And I think at least if there's something that's appealing about the market today is companies generally are still sensible capital allocators. They're not doing the silly M&A activity that we saw in the late 90s, early 2000. And that still gives me, from a micro perspective, because we're fundamental analysts through and through day and day, that gives me still some degree of confidence that there's some legs left in this market. And that more than anything guides my thinking is how are companies doing when I sit across the table from a CFO and try to roll it all up in their dedication to cash flow and particularly free cash flow. Because there are plenty of liabilities out there in the market, and I find I want to read the bears more and more now. So I want to get my hands on the Credit Strategist or all the Malden disciples and the people who Malden puts out in his research, the Howard Marks, certainly the Jeremy Granthams. I want to read all the bears I can because I think it really keeps me grounded in a sense of not getting over my skis and staying this party too long. So I think about checklists and I think about managing money, and this is the second in only 3 slides. And what guides me is 10% corrections, right? We've had 2 of them already this year. We get them once a year. The data's profound. Once a year, 75 years. We've already had 2 of them. Try to think about managing money, trying to be realistically anticipatory for the 25% bear market. So there's still few of these out there that would give you a red light. I, in particular, as an equity guy who used to manage fixed income, always thought the bond people were smarter than the equity people at the end of the day. So I watch high yield spreads. I watch investment grade spreads, which may actually be the better foretell of troubled times than everybody trying to watch high yield. But it still looks okay. And I'm going to get to the last slide before we tee it up for the Q&A with Ted, which is how it all comes together with that thoughtful 2 to 3 year view, not the proverbial, how are we doing this quarter, or what do you think 2018 is going to be like? So in portfolio construction, you think about risk and return. I try to carve it up into 4 separate buckets between growth and inflation. So I've got my growth bucket in the upper left-hand quadrant. I have my deflation left tail risk bucket, my inflation protection bucket, and then what's called my diversified bucket. So again, not terribly revolutionary, but then it's where do you want to be thinking about where to gravitate the portfolio to? And what's getting more interesting to me is the real bucket. I'm a true believer that inflation is a monetary event, that we have flooded the system with money thanks to the 4 major central banks on this planet, Bank of England, our Fed, the Bank of Japan, and the European Central Bank. And ultimately, we are moving into a more inflationary than disinflationary environment. So what's getting more interesting to me, either from the committee side, where we're adding things like MLPs, or looking harder at infrastructure or asset classes like that, is that in the last 30 years, we have been paid that you get these boom-bust cycles and it's more of a disinflationary environment. I think we're about to see the end of that, and inflation protection is something that's more important to me than it has been in the past. I have never owned a hedge fund. I have sat on investment committees. For the first time in clients' portfolios, I have been buying hedge funds because I think that trade out of equity into fixed income isn't the trade to do, and I think hedge funds start to make more interest because they have been so unloved and so beaten on. Now they look much more interesting if you find the right one than they did any time in the last 15 plus years. The deflation bucket is always going to have an allocation. That's my lowest bucket. That's my left tail risk. I think they're more interesting assets to own than certainly a 10-year US Treasury that yields 3%. And my growth bucket still has my highest allocation, but on the margin, it is coming down. What's controversial today, but still interesting, are things like EM equity, though the opinion is starting to diverge more. In the spirit of not talking your book, I think is a asset class that is always interesting and always potentially profitable is that small cap bucket. And God help us when we ever think we can figure out the growth value debate, but it starts to feel like certainly it is getting much longer in the tooth in this run to growth that was only interrupted in 2016. So that's how I try to think about portfolio construction, whether it's the real life of running money or investment committees that I sit on where what I just described is what we continue to gravitate to: diversified assets, real buckets, and that really sums it up. So in that spirit of not being the long warm-up act for the main stage, let's have a conversation with Ted Seides. I'll tell you, as I sit down here, about a year ago, I was sitting with a friend of mine in Detroit. He's probably, I think, pound for pound, the best investor in our city. He's a CIO for a major foundation, and he referenced capital allocators. And because you rely on your resource, I went and listened to one of them. This morning I listened to, it was number 56. They're great on the stair stepper. They're great on a walk. They're just wonderful resource tools for trying to think thoughtfully about managing money. So I don't need to introduce Ted more than that. He's certainly famous for a number of, from Yale to the Buffett bet to capital allocators to the number of boards you sit on. But most important is just as a resource, nobody has a monopoly on good ideas, but you sure bring a lot of good ideas through capital allocators. So I also promise that in these conversations, the interviewer dominates the question. I don't want to take a lot of time. I'd rather everybody, think about the questions they want to ask. So I thought maybe two general themes. One is more on the firms you talk to, and then maybe some thoughts on the market, the way you think about the market. So I've always been struck by when you talk to investment firms, more than anything, what do you think separates the best from the also-ran as an investor or the firms they represent?
Yeah. Well, before I say a word, I really want to thank Chris and Guy and the team at Dakota for having me. So much of investing and investing well is a learning and education process, and your jobs, especially now, are incredibly difficult. So for spending the time trying to think through, how do you get through to people? It's really valuable. I also think this movement to trying to figure out, is there a way to make this information more efficient on the digital site is going to be pretty interesting. The best firms from the good firms. I got really lucky in starting my career working for a guy, Dave Swenson, who was already gifted at picking out the best ones. And as a result of that, I got exposure to some of the best firms in the world that today are brand names, but back then no one had ever heard of them. And what happens when you do that is your bar gets set high without you realizing. So the hardest part about it is that the job of an allocator is to say no. It's their only job. You come in every day and you say no, 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 thank you, hopefully no thank you. I appreciate it, but no thank you. Now's not the right time, but really thoughtful idea. That's all you do. It's really hard. Once in a blue moon, something comes across your desk that aligns with how you think about the world, where you happen to be looking at that point in time, and some commonality of resonance with the people, and it just clicks. And I would say that all of the due diligence that goes into a sound investment decision is probably dwarfed by the first few hours of meetings and just the instincts of the people making the decisions. So, are there characteristics of those firms? Absolutely. And you don't need me to tell you what they are. They look institutional or they look boutique. They have the right sort of passionate people. There's aligned interests. There's all kinds of checklist things. But at the end of the day, when you've sat for years across the desk from people who are telling you their story that they are always passionate about, that they always believe in, and rightfully so, you're just waiting for the one that you think is better than all of them. And that's just, the competition's insanely difficult. And after a while of spending time with some of those very best people, you do detect subtle differences. So some of the things I talk to people about are insight, right? There's a difference between someone who has a really good strategy and somebody who has deep insight into why the strategy is better than another. And the people that are really gifted don't just see it in their strategy, they tend to see it in competitors, they see it in tangential strategies, sometimes they see it about the world, and you just find that you're kind of amazed that you're even in front of people like that. Not many people have that, and that's the point, right? There are many very good, worthwhile money managers who can beat the market over time. The best are on another planet.
Likewise, I don't want to say turnoffs, but I'm going to say turnoffs. What are the biggest turnoffs when you're talking to managers?
So people have their own biases. I don't like people who refer to what they're doing as me as opposed to we. I've seen very talented one-man shops refer to what they're doing as we. And then you see it's a very egocentric thing to do for somebody to refer to the firm as I'm doing this, I'm doing that. And those firms rarely make it. So even among those very talented people, sometimes you have folks that are hardwired in a way that I find a turnoff. There are a lot of little things that can happen. Arrogance is just a big one. There's no place in success in this industry for arrogance because everyone gets shot as soon as they're at the top of their perch. And I'll give you an example of someone who I've known for a long time, I'd say friendly with, Bill Ackman. I was at a conference at Harvard Business School probably 3 or 4 years ago. At the peak, Bill had just had his 50% year. And this was an alumni conference of investment managers. And the 2 days was almost an homage to Bill. Not his doing, but it was just, he had just raised permanent capital. He had just been up 50%. It was a Monday and a Tuesday. That Wednesday or Thursday is the day the news on Valiant broke. And it's been a rough slog for him since. It's very hard to put yourself out there with any sense of hubris and have it last. And so that's another big one.
The successful identification of the smaller emerging boutique firm, how do you think you find that better than not finding those firms?
So I think there's something different between new and emerging and small and call it established. So the new and emerging, it's almost the same lens. There's a big haystack and you're looking for the needle. And hopefully you see that the needle is going to look like one of these superstars 5 or 10 years later. Everything else is kind of the same. And the hedge fund industry in particular is really predicated on hopes and dreams. So it's getting more sophisticated now, but for so long, the answer to paying 1.5 and 20 and investing with an underperforming manager was to fire that manager and hire someone who was 2 and 20 who had done better the year before. So there was this notion of we'll just go to the new guy because hedge funds are magical and that new one's going to be magical even though the other ones hadn't. Smaller and established is really tough because most allocators have a perspective of if someone has a good long-term track record and they're only X size, why aren't they bigger? And if they're not aware of that own behavioral bias, or if their governance structure doesn't allow them to get past that, a lot of those sort of babies get thrown out with the bathwater.
The topic of groupthink, how do you avoid it? Either in an investment committee or at a foundation or a portfolio management team?
Yeah, by definition, we don't. So let's start with that. I think, I'm not sure if you said the industry is sort of half the industry's in a few hundred firms. So by definition, everyone is investing in the same firms. Groupthink exists. I think the more interesting question ends up being, is that right? Right? Is it the case that the reason those 200 firms have grown is because they're big, they have resources, they can hire very, very talented people, and as a result, they're at a competitive advantage to people who are smaller? There's always the trade-off of size versus opportunity set, but some of these large hedge fund firms spend an insane amount of money on people and data and basically R&D. So I don't know the answer to that. I spent 15 years looking for the smaller ones. And I had a very close friend from business school who was a partner at one of the large firms, and we would get lunch every 3 to 6 months. And I would complain to him about how the small firms were never going to be able to beat the large firms. And he would complain to me about how the large firms had too much money and they could never beat the small firms. It's hard. The data doesn't say anything. If you look at studies, they all say that small firms outperform, and they define small as so small that they're uninvestable. So there's no real way of knowing. And the other thing you can't do is you can't normalize for quality. So what you know is that every one of these large firms has very smart, talented people. And having spent time with the small ones, what you find is about half, or maybe even a little less, also have very smart, talented people. And half, we used to say, shouldn't be allowed to manage their own money, let alone anyone else's. Now, on average, those return pools look the same. So it's reasonable to think if you could normalize for quality that the smaller funds would do better. But it's either riskier or it's perceived to be riskier. And that makes that proposition extremely difficult to overcome.
This morning you released your 56th podcast. If you think about the most memorable moments, the most memorable takeaways, what would be the 2 or 3? 4 if you'd like.
Okay, so the most memorable moment was when I finished interviewing Scott Malpass at Notre Dame. So Scott and I have known each other for probably 25 years. And the reason it was the most memorable moment is as soon as I hit stop, I knew that it was exactly what I had hoped to accomplish, which was I hadn't seen Scott in a long time. I was curious what he was up to, and I figured it was really interesting. And we managed to sort of cover all that in an hour and a half. So that was the moment where I said, okay, that's kind of what I was hoping, then what? These things always go in ways you don't know and expect. And so one of the most enjoyable experiences I had was interviewing Annie Duke, a former professional poker player. I got lucky because she was about to do a book tour, and her book tour ended up being a podcast tour. But Mike Mobison, who's been a friend for a long time, introduced me to Annie ahead of time. So I was one of the first people to interview her. And it wasn't the interview that was interesting. It was that, I guess as opposed to other people who interviewed her, I read her book. And when we finished the interview, she asked me for feedback. And if you read her book, you would know that she was actually serious about that. And so at that point in time, I don't know, I'd done 35 or 40. I have a sense of how people present themselves, and what you hear in a curated, edited recording is quite different sometimes from a raw recording. So I was actually able to give her some feedback about her presentation and where she could emphasize things. And it sort of blew her mind, because she said, well, I always ask people for feedback and they just say you did a great job. So that's been fun, because we've developed a friendship out of that, and it just keeps going.
As the interviews have evolved from number 1 to 56, how have you wanted to take the interviews and the outcome that you want listeners to get when they listen to your podcast?
So I've evolved how I interviewed in a way that I really like. And so, David, you mentioned at the beginning, more and more and more I try to say as little as I can. I don't think people are coming on to hear my observations about whatever the topic is with who's ever there. And the other part of it that I have found enjoyable, and the feedback I've gotten resonates, is that it sounds like a conversation. And the reason it sounds like a conversation is because it is. I don't come anymore with questions.
Oops.
No, the closing questions I do, but I'll have an idea, depending on who it is, of the 3 or 4 topics we discuss, and that's what my notes are. And we just sit down and talk. I don't know most of the time what people will get out of it, but what I found is that just by showing up and listening very actively and asking the next question in the sequence, if I don't understand something, say why. If I say that, somewhere along the way you get some great nuggets, and they come from all different areas. So we were talking earlier, the one that came out this morning was with a guy named Tom Lydon, who runs ETF Trends. I don't know a ton about ETFs, but what a great way to learn. And one of the things he said that sort of blew my mind was that 95% of all ETFs are index products. And it turns out about 60% are pure indexes, and the other are, we call them active strategies, but smart beta, they're rules-based strategies. I had no idea that was the case. And then you could sit back and say, this is going to change the world of active management. It hasn't even started yet.
Personally, having met you for the first time, do people say, you come across as such a nice guy in these interviews?
Very well, I accept.
Yes. Today we've had quite a few questions on the active-passive discussion. We're never going to solve that. How about this? What frustrates you about active managers? What's the pet peeve with active managers?
If there's a pet peeve, I'm not sure there is because I'm a big fan of active management, but if there's a pet peeve, it's those active managers who don't appreciate effectively the competition, the competitive environment. Things have changed. And so when we were talking earlier about long-short equity hedge funds and how it's obviously been a very rough time, but it sure feels like it should be a better time. One of the things that's happened over the last 10 years, 10 years of a difficult environment to beat the S&P, the allocation community gets smarter. The product suite has changed. So 10 years ago when my bet with Warren started, if you wanted to buy active management, you had passive management, you had long-only active management, the vast majority of which was index plus or minus, and then you had hedge funds. And those were your choices. Now, with factor ETFs and funds, there's this proliferation of low-cost ways of gaining exposure. And when hedge funds had their heyday, 2000 to 2002, and did really well when the markets did badly, today people would say there was no value added. They were just long small-cap value and short high-flying growth. So what frustrates me at times about active managers and even hedge fund managers is they say, we just need a bad market to show that we're adding value. Well, maybe. But the definition of what adding value is has changed dramatically, and it's gotten more and more scrutiny, and rightfully so. It's just that 10 years ago, a lot of the people participating in the area didn't understand what your alternatives were. People grew up as hedge fund people, and they didn't understand what a long-only active fee was like compared to a hedge fund fee. It was sort of like this disconnect in markets in the same way that equity and credit markets used to not talk to each other. And so the people deep in the weeds who really don't understand what's happening in the landscape, that frustrates me somewhat.
What do you read? What are your most important must-reads?
So I've shifted a lot. I used to always read the Journal and the Times, and now I don't read the Journal, but I read Matt Levine's blog on Bloomberg, because he just does a better job thinking about corporate events than the Wall Street Journal does. I actually do use Twitter. I'm not sure if that's a good thing or a bad thing. It's definitely addictive, but it's where I see a lot of interesting stuff. I read a lot of investment letters, always have, and that's just the very clear-minded investment managers are something that's cathartic for me to read. And then increasingly, I'm trying to read books. Some of it I get forced to because I'm going to interview someone who authored a book. So my friend Brian Portnoy, who's coming on the show, I think it's next week's episode, has a book called The Geometry of Wealth that just came out today. And it's just a terrific, he was in the same shoes I was as a professional hedge fund allocator. And then the last bunch of years, he's worked with private wealth clients and has this sort of fresh perspective on what matters. It's really a very elegant book.
2 or 3 most recommended books?
In the investment world, Annie Duke's Thinking in Bets is something everybody should read. I came across a book called Pitch the Perfect Investment by Paul Johnson and Paul Sonkin that should be CFA #1 textbook. It is a very elegant description from 2 really professors, they were also investment managers, who walk through what a company is, how you analyze it, and most importantly, how should an idea get presented so it gets heard.
Recent podcast.
They both were podcast guests as well. And the third, I would say, a book called Big Data Baseball. if most of the people here have probably read Moneyball, if you liked it and you like baseball, big data baseball is Moneyball 2.0. If you like Moneyball and you don't like baseball, don't bother.
What was often referred to as the Yale model or endowment envy, how do those portfolios look today?
Well, if you are a large endowment, they look fantastic. I sat at Yale, and David wrote his book after I had left, and so I felt like I knew what was coming on the next page. And the book and the model, in my opinion, are misinterpreted. And they're misinterpreted because they focus on outcome and not the process and the input. So without going into that, what I would say is that if you have a long-term asset allocation with a long-term pool of capital and an aligned governance structure and a group of investment managers that you've spent 30 years curating, you have what we call in the investment business a wide moat.
Couple of investment questions with a longer view. Most interesting ideas to you today?
Micro buyouts. It's very hard to find really interesting looking investment opportunities, but there's a massive supply-demand mismatch of small private companies in the US. Very, very hard to access, doesn't scale, but if you can find someone, and there aren't many, but who's good at that space, you can still buy steady businesses with sellers for non-economic reasons. Usually it's a demographic change with the long-standing owner retiring for 4 or 5 times.
Is there a contrarian idea in the TED portfolio today?
No.
In that light, what's the proverbial crowded trade, the least inspiring trade?
I don't know if it's the wrong trade, but it's clear that the S&P 500 index fund has had an unusual run. And my old partner, Scott Bessent, who later ran Soros, used to say, when everyone's leaning on one side of the boat has a tendency to right itself, even if you have no idea why. And we used to talk about that in like late 08, early 09, and now is one of those times, right? It feels to me like the S&P 500 is too popular. Fund flows will come in. So much of this indexing move is correct in terms of it is true that my parents, who still don't own index funds, but they should, because they don't know what they're doing. But you also have this run in the S&Ps coincided with maybe unique, I'm not sure, but highly unusual period of time where the largest companies in the US market are also the fastest growing. Usually growth slows down with size, but the tech giants have just been extraordinary over the last decade. And so the law of large numbers tells you that either they become the country, which is possible, or that dynamic will change and smaller companies will grow faster and therefore do better in the market.
The often asked Buffett wager question. Would you take that wager today if you could pick 5 individual hedge fund managers?
So that's the answer to that is either yes or no. So I try not to answer that question at first because, like anything else in investing, process matters more than outcome. So especially after I interviewed Annie Duke, I really spent some time trying to think about what was the process 10 years ago at making that bet. Was it a good process? Would I make that bet again, given the set of facts I had at the time? Did I make mistakes in perspectives, outcomes, probability distributions? And I came to the conclusion that I did make some mistakes in terms of really thinking through what could happen. But today, I believe the odds were very, very high that hedge funds would beat the market starting 10 years ago. Today, I think it's a wash. meaning I think it's a coin flip over the next 10 years, hedge funds versus the market. And that only has to do with the fact that I think the market is still highly valued, because hedge funds in aggregate are far more competitive than they were. As I mentioned earlier, there are a lot more investable options to get at exposures that you couldn't get at. And the last really residual question that got blown away in the bet the last 10 years and probably won't in the next 10 is that most of that bet is actually large cap stocks versus small cap stocks and international markets versus the US. So one of the little known facts about the bet is over the same 10-year period where hedge funds really underperformed by any measure, that group of fund to funds basically matched the Morgan Stanley World Index. Hundreds of basis points a year behind the US, but significantly outperformed international markets, was a little bit behind the Morgan Stanley World. So there's so much in sort of what's the underlying benchmark. I knew that 10 years ago, and I thought he had made a bad bet, and it looked like he had for a couple of years, but he's Warren Buffett and I'm not.
We should open up the questions, but you're very good at the end asking the personal questions of your individual you're interviewing. You're on a desert island. I'm going to show my age. You get one record album. What's that album, Ted?
Oh, boy. It's got to be a really long song, right?
One album.
It's probably Les Mis. Never actually answered that before. I'll think of something else.
All right, questions from the audience for Ted. And the lighting is tough, so I'm going to need some help here.
We have a question back here.
Sure.
It came over Facebook Live from Patricia. Oh, it's from our friend Chaz Burkhart. And Ted, this is for you. Ted, what percentage do you think the firms that you have seeded has met or exceeded expectations?
From Chaz, huh? Depends how you define expectations. We used to define expectations as at least performing in line with our fund, and then if there was growth beyond that, it was sort of a free call option. And I would say the answer was probably a little over half. But if I said that lens is gone, how would someone who's seeding a group of managers define expectations? They might think that means they grow to $1 billion and you get really rich off of that one fund, and that was probably at best 10%.
Some more questions. Yes, sir.
What podcast do you listen to? Everybody asks about books. What about podcasts?
Thanks. My favorite is Patrick O'Shaughnessy's, just because actually how I got into podcasting in the first place. Invest Like the Best. He's a polymath. He's just an incredible interviewer. I listen, especially this time of year or the last couple of weeks, I listen to Bill Simmons' podcast and all the NBA playoffs and stuff like that. I dabble a lot. So it's weird that there's like this, someone called it FinTwit, I didn't realize, but there's this micro community of some of these people. So I've got to be good friends with Shane Parrish, who's just brilliant, and his Knowledge Project is a fantastic podcast as well. So those are probably my favorites.
Other questions?
Yep. Another question back here. So Ted, it's key. We've heard a lot from the audience about what it's like to meet with a manager. You go in, be prepared, have all the basics covered, but you've met with hundreds and hundreds of investment managers. Could you just give us some insight into basically what the best do, but also comment a little bit more on the comment you made about the intuition in the first few hours of meeting with someone? And then how, as us, as sales and marketing professionals, and in fact, any portfolio manager, how can they better prepare for that sort of one shot on goal? Because if you, right, it feels a little bit, not completely binary, but you want to put your best foot forward when you have the opportunity.
Yeah. So I would start by saying that despite what every allocator will come up here and say, that investment management products are sold, they're not bought. However, all of the allocators think they're buying. So the one thing that you can really do to prepare is repetition. And that repetition can come in front of a live audience, and hopefully it's not the highest and best use of the time for you. But there is something to, let's call it the gift for gab. You just don't find many funds where the portfolio manager, who's ultimately the person people are buying into, can't articulate what they're doing extremely well. So that's the one part of it. Now, can you get better at it? Sure you can. It just takes practice. It's a form of public speaking, so you can practice in your conference room in front of your team. We used to talk to people on our team that every single time you opened your mouth in a room that had more than 3 people, you were public speaking. Watch your pregnant pauses. Don't say like too much. Don't say too much. So things that you can actually practice just by becoming aware of it, it helps. What you can't do is take someone who has a certain set of skills and is good at it and try to put them in a different bucket. So what I mean by that is there are managers that are very, very good at the one thing they do, right? They're hedgehogs. If you go into a meeting with someone else who you sense would rather be investing in a world-beating kind of fox, you can't put them in that bucket because they're just not going to win the business anyway, and you might be wrong in guessing that that's what the person wants. So there's a consistency of who the person is, what strategy are they pursuing, and how do they present themselves. And when all those things get aligned, and then there's obviously a lot of luck where the person across the table from you is looking for those things, that's when you get a good match.
Yes.
To a less sophisticated private client or less sophisticated institution, how would you articulate the process versus outcome sort of focus? How do you orient them towards process versus outcome?
Did everybody hear the question?
So the question was, how do you articulate the importance of process over outcome for someone who's less sophisticated? I think you just introduce the concept. I haven't actually, been in that seat. I've been fortunate that I've really mostly worked on the institutional side of my career. My guess is, and I'd have to do the work to figure it out, is you need some analogies. You need some real-life examples of process versus outcome that don't have anything to do with investing so that people can kind of start nodding their heads when you talk about the parallels.
Other questions? I got to say, when Guy asked me to come here, and the chance was after listening to your podcast, that was a treat. To make the drive from Detroit to meet you and being a big fan of the podcast on the stair stepper or a nighttime walk, they are just a pleasure to listen to.
Thanks, David. Really appreciate it.
Thank you.